Hi, my name is Billy Flowers and welcome to my channel where I talk about velocity banking and how we can use this strategy to massively pay off debt. So in today's video, we're going to be talking about paying off one of the hottest cars on the market today, a 2025 Chevy Trax. So let's get started. So we're going to be starting with our four key numbers. We have our income at $5,000. Our expenses are at $4,000. Our debt is our car at $28,900 and our cash flow is at $1,000. Now we do have a debt tool, our line of credit at $10,000 at a 15% interest rate, and our car payment is $492.72 per month, and it's at a 7% interest rate for a term of 72 months or 6 years. Now down here, I've broken down the first 6 months of the amortized schedule, broken down in interest and in principal. So the first month, we're going to be paying $168.58 in interest. Yes, $168 of $492 is going towards interest alone. Now, like I explained in a previous video, one of my first videos, amortized loans are set up where all the interest is front loaded. But they tell you that the interest rate is 7%. And then you look at your interest that you're getting charged on your schedule, and you're looking at that and you're saying to yourself, is that 7%? Because it doesn't look like, you know what? Don't take my word for it. Like I always like to do, we're going to go to school. So you're just going to break out your phone or go on a PC, right? And we're going to open up Google and see what the actual percentage is of this interest that's getting charged. So let's do this together. So you're going to open up Google and you're going to type in $168.58 is what percent of $492.72. So I already did that on my phone here. And what you're going to get is 34.2%. Yeah, I said that right. 34.2%. Yeah. So does 34 sound like 7 to you? Are they even remotely close? No. So you're going to be paying 30% interest in these first 6 months alone. Easy. But it says 7. See, that's how the banks make their money. They're charging all that interest up front, getting all that interest from you, and you're going to end up paying thousands of dollars in interest. Thousands. By the time you pay off this car, if you just do the regular monthly payments. But us velocity bankers, no, we ain't playing this interest game. We don't play that. We like to chunk at the car so we pay less interest in the process. So let's get back to the schedule. So like I said, we have $168.58 going towards the interest and $324.13 going towards the principal in month 1. Month 2, $166.69 in interest, $326.02 going towards the principal. Month 3, $164.79 in interest, $327.93 for the principal. Month 4, $162.88 in interest, $329.84 going towards the principal. Month 5, $160.95 going towards interest, $331.76 going towards the principal. And the last month, month 6, $159.02 going towards interest and $333.70 going towards the principal. Now, as you can see, during these months, these numbers barely moved. I mean, you're talking from 168 down to 159. I mean, that's like $9. and then principal went up maybe 12. That's it. 324 to 323, 333. Never mind. That's $9. Man, I can't even. Whew, I can't even do math myself. That's only like $9. That's nothing. So let's see how us velocity bankers work. Let's get started. So we're going to take $10,000, our first chunk at the car, and we're going to put it towards the principal. And that's going to put us around 18,700. And that first chunk is going to put the amortized schedule all the way out until March of 2027. 2027. And since we made that chunk, the interest that we're going to get charged the first month of our regular monthly payment is going to be $111.25, and $381.46 is going to be going towards the principal. You see the difference? This first month, what we would have been paying if we didn't chunk at the car. See the difference? We went from 168 down to 111. 324 is now 381. I'll take that. And it's going to keep going up from there. Remember that, because we have to pay down this line of credit. But we're going to be paying the regular monthly payment every single month because that's part of our expenses. So, like I said, month one, $10,000 is going towards the principal of the car. Our income is going into the line of $5,000, lowering the balance down to $5,000. Our expenses, which includes our car payment, is $4,000, raising the balance up to $9,000. Notice we started with $10,000. After our expenses came out, it went down to $9,000, and that's our cash flow. Of course, we're going to get charged interest of $112.50, raising the balance up to $9,112.50 at the end of month one. Month two, we have our income going in, our expenses coming out, raising the balance up to $8,112.50. $101.41 is the interest. $8,213.91 is the balance at the end of month two. Month three, income in, expenses out. $7,213.91 is the balance. $90.17 is the interest. $7,304.08 is the balance at the end of month three. Month four, we're going to repeat the same thing. Income in, expenses out. $6,304.08 balance. $78.80 is the interest. $6,382.88 is the balance at the end of month four. Month five, income in, expenses out. This is the interest that we're getting charged, $67.29. The balance is going to be $5,450.17 at the end of month five. Month six, income in, expenses out. Balance, $4,450.70. Now the interest that we're going to get charged, $55.63, raising the balance up to $4,505.80 at the end of month six. Notice at the 6 month mark, we went from paying $112.50 all the way down to $55. Not too bad. Now, since our balance is under what we put in, this is where I like to do the flip, where we have our expenses come out first and our income come in second. So it'll just make it a little easier to see the line paid down to zero, so we're not putting in the exact amount or having a difference or having a negative number. It just makes the math look easier on the board to see. So in month seven, we're going to have our expenses come out first. the $4,000, raising the balance up to $8,505.80. Now we're going to have our income go in, lowering the balance down to $3,505.80. Interest we're getting charged $43.82. The balance is going to be $3,549.82 at the end of month 7. Month 8, we have our expenses coming out, our income going in. The balance is going to be $2,549.62. Interest, $31.87. Balance, $2,581.49 at the end of month 8. Month 9, we have our expenses coming out, our income going in. Now we're down to $1,581.49. Interest we're getting charged now is $19.77, raising the balance up to $16.01.26 at the end of month 9. So we got month 10. We have our expenses coming out, our income going in. Now our balance is at $601.26. Look at that interest. $7.52. Nothing. Raising the balance up to $608.78 at the end of month 10. Whew, man. Starting to sweat now because we getting to the end here. Month 11, we have our expenses coming out, raising the balance up to $4,608.78. Whew, and like I always say, you know what time it is. That's under what we've been putting in. So as those expenses come out, we're just going to be paying them throughout the month. We're going to zero this bad boy out. And we're done. $10,000 wiped out in 11 months. First $10,000. So what are we going to do now? We're going to do this all over again, right? We're going to do this all over again. We're going to put another $10K on the car. But like I said, what were we doing this whole time? We were paying our car payment, and this took 11 months. So we have 11 months of car payments of at least $381.46. So that's around $4,100 of payments on top of the $10,000 we put in. So total, that's around $14,000 off of the car. So what is that going to do? So that means that we have about $14,700 left. So we're going to take another $10,000 chunk, right? And we're going to put it on the car. And then what's that going to do? It's going to take it down to $4,700, right? And just by looking at these numbers, if it takes us another 11 months to pay this line off, what do you think the regular monthly payment is going to do? You think it's going to wipe that out? Of course it is. Because right here we were paying $381 per month. Let me get my notes just to make sure. All right. So the payment over here is going to be starting out at $429.18. So starting off, we're going to be paying $429.18 for the 11 months it's going to take us to pay off this second chunk. So this car is going to be paid off in another 11 months. So 11 plus 11 is what? 22 months. Isn't this amazing? 22 months and the car is yours. Remember, this is a 72-month loan and we paid it off in 22 months. I mean, I don't, isn't there 12 months in a year? So 12 plus 12 is 24. That's less than 2 years, right? Less than 2 years. Let's just say 2 years. Just to be safe, because you got some holidays in between there, and you might want to go out and have a little fun. So let's just say 2 years. Your car is paid off. You got the pink slip now. This car is yours. Only thing you got to pay now is the insurance every month. No more car payment. And on top of that, once you pay this car off, what's going to happen? What are you going to get back? You're going to get that cash flow, right? So your cash flow is going to go up $492 on top of your $1,000. So now you got $1,492 in cash flow. Ain't that great? So we're going to go over here and we're going to look at the interest that we paid on the line of credit. So each chunk was $608.78. So since we did two chunks, that equals $1,217.56. The interest that we paid on the actual car loan, with the amortized schedule, is $1,284.03 for a total of $2,501.59. So we end up saving $4,073.98. You got $4,000 left in your pocket. Now I'll take that any day of the week. An extra $4,000, you saved $4,000. Isn't that amazing? And the interest that you would have paid, let me get my notes, that you would have paid if you just made the regular monthly payments would have been $6,575.57. That's the total interest that you would have paid if you just would have made the regular monthly payments. $6,575. We saved 4,000 of that. Ain't that crazy? I mean, this is just math. That's all I did. Just math. And you know what? Let's go to school right quick. Let's see if $1,256 is actually 15%. Let's see if we saved on the interest game. So let's break out your calculators again. And you're just going to type in $1,217.56 is what percent of, we did two chunks, right? 10,000 a piece, so that's 20,000, right? Wow, it's amazing right here. Let me put this over here so you can see it a little better. So you can see it. Might have to turn your neck a little bit, but there you go. 6.08%. That's how much interest you actually paid. So let's just say 6 to 8%, just to be safe, maybe even lower. Just depending on the interest cost and how, if you follow this exactly, because this is not an exact science, because of course this is the perfect scenario where your bills never change. Sometimes your bills might change and you might have a little bit of extra electric this month because you're in the summer months, or your gas bill might be a little bit more, or you decide to take a little trip, for the weekend, something like that. But we'll just say, 6 to 8%. That still beats this, right? I mean, over here, using a line of credit, we winning. Was we winning over here? Remember, this was 30%. This says 7. We was 30% over here. So I'll take this any day of the week. So this is how you pay off a brand new 2025 Chevy Trax with $1,000 of cash flow and you're paying it off in 2 years. Mm-mm-mm. Riding around with the pink slip in 2 years. Man, I'll take this any day of the week. So I just want to thank you for watching. And don't forget to like, subscribe, and comment below. And like I always say, get that cash flow.